All right, good morning, everyone. Welcome to this transfer pricing webinar. Today promises to be very interesting. Today we're going to be discussing the first transfer pricing judgment, which resulted in a 1.7 billion naira assessment. We're going to be talking from a taxpayer's perspective to learn some lessons from the case. My name is Amaka Samueluyani. I am a senior manager at Anderson Tax Nigeria. So to provide some form of guidelines as to how this webinar would run, Dr. Josh will be taking the initial session. He'll be providing a background into the case and key learning points from his perspective. Thereafter, there will be, we'll discuss the results of the survey. If you can recall, while you were registering, we asked some certain questions. So we'll discuss the results from that survey. Then we will go into the panel session. We have 4 very knowledgeable professionals who will be answering some of the questions that you put down while registering. Okay, so let's go straight into the webinar. Dr. Josh is a partner and head of transfer pricing practice at Anderson Tax Nigeria. He has over 12 years experience working in various jurisdictions, including the United States, South Africa, Ghana, and of course, Nigeria. He's a specialist in TP documentation, audits, and litigation. Thank you, Josh. You're up next.
All right. Thanks for having me. I'm going to put up a short slide that we're going to go through just to get a sense of the background to this particular case. Just a minute. Okay. All right. So in the next 10 to 12 minutes, what I'll try to achieve is to give us a background to the first transfer pricing judgment in Nigeria between a taxpayer called Prime Plastichem Nigeria Limited and the FIRS. And we'll basically try to understand the nature of the case and try to highlight some learning points before we go to the Q&A session with the rest of the panel. All right, so basically this is a very simple case if you look at it from a transfer pricing perspective. And this case, as I said, was between Prime Plastichem Nigeria Limited, which I'll be referring to as a PPNL, which is also the appellant or the taxpayer, and the FIRS, which is the tax administrator or the respondent. In here was an assessment, additional tax assessment of about 1.7 billion just for 2 financial years, FY 2013 and FY 2014. Because it's a transfer pricing case, clearly it had to do with a related party transaction that the taxpayer was involved in. This related party transaction was the purchase of plastics and petrochemical products from an offshore sister company. That company is called Venma Overseas Limited. So we're calling it the overseas entity or VOL. So this purchase is a very simple transaction. In other words, when compared to other forms of transaction, a purchase of tangible product is pretty simple. Because if it were a service transaction, then the taxpayer has to first and foremost convince the FIRS that the service was actually provided and was needed or beneficial, even before you determine whether the fee charge is reasonable from an arm's length perspective. A similar argument can be made for intangibles, where you need to first and foremost establish that that intangible was unique and valuable and beneficial to the license and the licensee. And the same argument can be made for loans, where you need to establish if the borrowing is coming from the subsidiary. Then you need to establish that the parent company actually fully capitalized that particular subsidiary before making that loan, even before you think about the reasonableness of the interest rate. So when it comes to tangible products, it's pretty straightforward, because clearly that product that is purchased will reflect in the P&L of the taxpayer as cost of sale. So the issue here is whether the price was inflated or not. So in the case whereby FIRS can establish that the price was inflated compared to what would have been the case if they are sold to an independent party, then they would argue that the profitability of PPNL has decreased artificially due to transfer pricing, and therefore make an adjustment and assess additional tax liability. So that is basically the crux of the issue. Now, what we need to be mindful is that the fact that a transaction is simple doesn't mean that it's not risky. The riskiness of this particular transaction, can be seen from the fact that PPNL was purchasing solely from a sister company. That means that the volume of related party transaction was very significant. And if it's significant, then any form of dispute in terms of the pricing can lead to a significant adjustment and therefore a significant assessment of additional tax liabilities. And that's actually what we saw. So let's talk about the related party transaction, because the bone of contention actually boiled down to the economics of the analysis. So the first point of divergence was the fact that for financial year 2013, the taxpayer had used a particular methodology called the comparable uncontrolled price to determine the reasonableness of the price of the related party transaction, whereas FRS during audit determined that the appropriate method should have been a transactional net margin method. So there was a disagreement in the appropriate methodology that needed to be used to determine the reasonableness of the pricing. Come FY 2014, taxpayer changes its most appropriate methodology from CAP method, which is a comparable uncontrolled price, to the TNMM, which is the transaction net margin method, which was similar to the same method that FRS had chosen as most appropriate for 2013. So at least for 2014, both parties agreed on the same methodology. But once again, there was a source of divergence. FRS argued that the most appropriate profit level indicator that should have been used in applying the TNMM should have been the gross profit margin, as opposed to the operating margin or net margin that the taxpayer used. So that was the second source of divergence. So FRS, by using TNMM for both years and using gross margin as a profit level indicator, then yielded different results from the taxpayer, which led to the assessment of the additional tax liabilities. So it begs the question, why TAT actually, agreed with FRS's position in order to actually side or rule in favor of the FRS. That will be part of the lessons that we'll learn from this particular session. Just a few comments before I go to the lessons learned. If you look at the judgment, all right, technically, it appears that the taxpayer had a very strong argument. But if you look at the way whoever represented the taxpayer, put forth their arguments, I believe that they did a relatively poor job compared to what the FRS did. So for example, the responsibility of a taxpayer is to actually prepare a very robust TP documentation in which you talk about the facts that are relevant to the control transaction. And it's based on those facts and circumstances that you can actually determine the appropriate methodology and therefore implement that methodology. Throughout that judgment, missing in that case was any presentation of the facts that pertain to that particular transaction. So rather than the taxpayer focusing on the facts and based on the facts selecting the most appropriate methodology and the PLI, they kind of focus more on the authority of FRS in actually rejecting the work that they've done and assessing additional tax liabilities. For me, that is analogous to the policeman, stopping you for a traffic offense and, charging you with some particular fine. And rather than convincing an independent court that you did not commit the offense, you're rather challenging the authority of the policeman for even, first and foremost arresting you and then assessing that particular fine. I think that strategy was clearly wrong and played to the advantage of FRS. So throughout this, what you're going to recognize is that transfer pricing is fact-based, all right? First and foremost, you need to present the facts of the case, and usually the taxpayer has an upper hand in that particular department because you know your business more than anybody else. And once you've presented those facts, based on those facts, you are able to then determine the most appropriate methodology. So for example, for FY 2013, it was very clear and evident based on the presentation made by the taxpayer that based on their business strategy, the offshore entity was selling the same product to their related party in Nigeria, as well as to independent parties in Nigeria. So that is what they needed to stress on. So in that case, that means the nature of the products, whether similar or the same. The next argument is that if they are the same and they are being conducted in the same economy, then the economic circumstances are also the same or similar. Then the third comparability factor you needed to then convince the panel about was that the contractual terms, be the volume, be transportation, be payment terms, are also similar. If they are not similar, you make adjustments for those disparities. Once you can convince the panel of the validity of the comparable data you are using in terms of being highly comparable to your control transaction, then you can convince them that that was the most appropriate method, because the OECD guidelines clearly states that if you can use the CAP method reliably, it yields the most reliable results compared to the other four methods. So clearly they didn't do a good job of making a compelling case to the panel. There's this assertion or misconception that the panel, the TAT, needs to be knowledgeable in transfer pricing. And transfer pricing being a highly technical area, we might not be getting fair judgments because those in TAT don't know transfer pricing. But the truth of the matter is that just like any other case, it's the responsibility of the taxpayer to tell his or her story. And if you tell your story very succinctly and apply the principles in the transfer pricing regulation, OECD guidelines, and the UNTP manual, you'll be able to convince any layman that you did the right thing. You need not get TP experts to be part of the panel to make that particular judgment. In this particular case, it was a loss of opportunity for the taxpayer to articulate the facts pertaining to its particular transactions, and therefore convince the panel that they did the right thing. Unfortunately, FRS appeared to have done a better job making references to the OECD guidelines and UNTP manual. In some cases, making very stretched arguments, in some cases, even false arguments, but they were able to persuade, the panel, and therefore won this case hands down. And so I believe that there are a number of learning points that we can take from this. So I'm going to wrap up by quickly going through a few learning points. The first learning point from this case is the fact that when a taxpayer starts its transfer pricing journey, the first responsibility is to file your transfer price and returns. That responsibility means that you are making disclosures to the tax authorities, and based on those disclosures, the tax authorities will perform a risk assessment and determine the taxpayers they are going to audit. At that particular point in time, all right, before you start filing your TP returns, you need to have the end in mind. In other words, you need to ask yourself, should I make these disclosures and FRS finds some TP risk and then select me for an audit, and there's a dispute? How am I going to resolve this dispute? Am I going to litigate? Am I going to negotiate? Or am I going to settle? The choice of those three, any of those choices, will determine how much work you need to put in terms of putting together your TP documentation, which is the first line of defense. So it's imperative that you always have the end in mind when you commence your transfer pricing compliance journey. Secondly, you need to proactively evaluate TP dispute resolutions. I've already talked about that, and that is in line with the first point. So you typically might have the basic TP dispute resolutions, settlement, where you might argue for a payment plan, negotiations, where you negotiate for a lower liability, or you litigate, where you believe that you have a strong case that hopefully you might end up with zero liability. All these discussions should actually start from the onset. You don't wait till the end of the audit that you start thinking about your dispute resolution options. Thirdly, prepare a robust TP documentation. This cannot be overemphasized. Your TP documentation is actually your first line of defense. Many a times, taxpayers treat TP documentation as a check-the-box item. In other words, I need to advise, have I filed my TP returns? I check the box. Have I prepared TP documentation? I check the box. But TP documentation goes beyond just comply. It is your first line of defense, so that if there's an audit, that is the first document that the FRS is going to request for. And if you go to court, that is the most important document in addition to all the supporting documents. So you cannot take it lightly. How you prepare your TP documentation will determine the potential liabilities that you might end up having to pay at the end of it all. Building an audit defense file proactively is also critical. Your TP documentation, might not include all the relevant supporting documents. For example, invoices, intercompany agreements, ledgers, trial balances. All these are supporting documents that are not part of your TP documentation report. So you need to have a file that contain all these so that you can use them when you go through the audit process. Be mindful of the fact that now we have administrative penalties for lateness in submission of these supporting documents. So proactively compiling an audit defense file is a best practice that we need to be encouraged to do. Now, you need to also conduct periodic TP health checks. I always say that, you cannot totally eliminate TP risk. TP as a discipline is not just the interpretation of the law or the regulation. It's an application of a concept that has strong economic theoretical underpinnings, but its application has a lot of judgment. So there's definitely going to be a source of dispute once you get an audit by the FRS. So it's important that periodically you do a TP health check to see whether you've mitigated some of these risks. A very bad analogy would be the fact that just like coronavirus cannot be eradicated, but can only be contained. So it's the same for TP. It cannot be eliminated, the risk cannot be eliminated, but it can be mitigated. Finally, I would say that you need to engage sound TP advisors. TP is a highly technical area, very subjective, but you need a TP advisor that can tell your story, that makes sense, that the layperson can even understand the technicalities behind it. It's not a matter of just quoting cases just to support whether the FRS has authority to do something or not. It's a matter of going to court and telling a story so that the layperson understands your business and why you have a particular pricing arrangement between two related parties. And you can demonstrate clearly that even if you were dealing with an independent party, you would have come up with the same outcome. So these are some of the key learning points. I'm going to wrap up at this point and leave it to Amaka to move forward with the session. Thank you.
Thank you, Dr. Josh. I think the key learning points from your presentation is the need for taxpayers to be proactive in terms of dealing with their transfer pricing risk. In the interest of time, I'm going to quickly run through the survey. So far, we have about 144 attendees in this webinar, and we thank you for joining us on this webinar. So I'll just quickly put up the results of the survey. Okay, so we carried out a survey at the point of registration, and we basically asked 4 questions to the people registering for this webinar. I'll run through the results of each question. So question 1, how would you rate your organization's TP risk considering the first TP judgment in Nigeria? It was interesting to see that about 62% of the respondents said that their risk is now between medium and very high. What you need to consider if you fall within this category is how are you going to manage this risk? Whether or not you are under audit, you have to ask yourself, how are you going to plan for an audit in order to manage this risk? As we can see, the assessment arising from a TP audit can be so significant. I mean, 1.7 billion naira is a significant amount. So taxpayers, just like what Josh said, you must be proactive. You must think to yourself, how do I manage the risk for the past years, and also plan for the future. So if you have related party transactions that create significant risk, perhaps in the way you are conducting them, you might need to evaluate those related party transactions and ask yourself, how best can I mitigate or possibly manage this risk in the future? Now, question 2 talked about, the question was, what is your organization's major source of TP risk? And about 60% of the respondents said that their source of TP risk is with respect to complying with the TP regulation. That is in terms of filing a TP return or a lack of a robust annual TP documentation. Now, if you fall within this category, again, just like how Josh said, when you're preparing your documentation or when you're filing your returns, you have to have the end game in mind. When you're disclosing this information, you have to ensure that this information is robust enough to substantiate your related party transactions. If not, you're just creating further risk for yourself. And next to that, 27% of respondents says the absence of TP readiness document file is their major source of risk. I mean, proactivity cannot be stressed in this regard. You have to ensure that you collate and retrieve all necessary information to substantiate your related party transaction. For transfer pricing, the amount of documentation, the amount of information you need can be humongous. And it's not just local documentation, that is documentation in Nigeria. You would also need documentation, probably cross-border transactions. You have to relate with your parent company abroad, and that may take some time. So we always advise taxpayers that they should be proactive in preparing for TP audits and collate all necessary documentation to support their related party transaction. Now, question 3 says, in the event of a TP audit, how would your organization handle it? It was good to see that about 62% of respondents say that they would have a TP advisor to support them through the audit process at one stage or the other. I believe Josh has also mentioned that TP is highly specialized. The economics of TP requires a specialist who is very knowledgeable in that area. So it was good to see that a majority of the respondents believe that they would require some form of support with respect to the TP audit. Now, the last question talks about TP dispute resolution option. It says, what dispute resolution option would your company be willing to adopt in the event that the TP audit results in a significant dispute? I mean, just because of the way transfer pricing is, the likelihood of a significant dispute is quite high. About 88% of the respondents said they would enter into some form of negotiation with the FIRS, which in itself is not a bad dispute resolution option. However, you should go to the negotiation table from a position of strength. You should have a strong position to defend what you have documented. And how do you have a strong position? It goes right back to your compliance documentation. What did you have in your TP returns? What was your documentation robust enough to substantiate your related party transaction? Even throughout the audit process, were you able to provide sufficient documents to support your related party transaction? That is what would help you build a strong defense. So when you go to the negotiation table, you have a strong position to negotiate with. It's also not surprising to see that only 6% consider litigation right away. Generally in Nigeria, people shy away from litigation with respect to tax issues. So those are the results of the survey. Those are the results of the survey. I think we can go straight to the panel session. Like I said earlier, we have 4 very knowledgeable professionals who will be answering some of the questions that you put down during the registration. However, if you have any other question that you would like to ask, please feel free to drop it in the Q&A section below. So I would like to introduce the panelists. First up is Kevin Kian. Kevin is the Managing Director and Global Transfer Pricing Leader for Andersen Global in the US. He has over 31 years of professional experience in transfer pricing, and he has served clients in various industries such as media, entertainment, engineering. He has gained significant expertise in TP documentation, audit defense and litigation, and also IP planning. Hi, Kevin. Welcome to the panel.
Thank you, Amaka.
Okay. The second panelist is Nitin Narang. Nitin is the partner of the International Tax and Transfer Pricing Practice in Nangra Andersen Consulting in India. He has over 13 years of professional experience in handling international tax and transfer pricing matters. He's also involved in TP documentation, advanced pricing arrangements, master file, country by country reporting. And because India has so many transfer pricing cases, it was only apt for us to invite our Indian colleague. Thank you, Nitin, for joining us on the panel.
Thank you, Marka. Thank you, Dr. Josh. Thank you, everybody, for having me here.
Our third panelist is Dr. Titilayo Fowokon. She's the Group Head, Strategy, Tax and Compliance at Dangote Industries Limited. She has over 26 years experience in audit, accounting, taxation, cutting across various industry, including the financial service industry, oil and gas, manufacturing. She's also in leadership positions in ICANN and CITN. Thank you, Dr. Fowokon, for joining us.
Thank you, Amaka. Thank you, Josh. And nice seeing you and Kevin. Thank you.
Okay, the last person joining the panel session is our very own Dr. Josh. Okay. All right, we'll dive straight into the questions. Kevin, what is your view on the TP judgment and what would be your advice to the taxpayer?
Yeah, it's a good question. It's a tough question to answer. I hate to presume that I know what the legal situation is in Nigeria. These matters are always particular to the jurisdiction in which they're being weighed. But my impression, my first takeaway is that it's very unlike what you would see in the US. In the US, the court decision on a transfer pricing case would have an extreme amount of detail regarding the factual development, as you were saying, as Josh was saying. It does come down to the facts, and it's not simply just a matter of having facts, it's the theory of the facts. As we say in economics, without theory, the data is silent. So there would be more development of the theory in terms of how the company or the taxpayers' profits are generated, and what role is played by the activities of the related parties. What do they contribute to the development of value? I feel like that is something that was missing. And I also feel that some of the statements, maybe by both sides, are what we call conclusory or declaratory statements. They're assertions that don't seem to be supported by reference to facts or analysis. Now, I don't know, maybe there was more, but you would typically see a much longer opinion in the US. It's not atypical for a transfer pricing court opinion to be over 100, maybe 200 pages long, and maybe 40% of that is just about the facts. So that's my takeaway. Sorry, Amaka, you're still on mute, I think.
All right, thank you, Kevin. Thank you, Kevin, for that. Nitin, same question. What's your view on the TP judgment and your advice to the client?
Amaka, I totally concur with the view that Kevin has put across. You know, India, like you mentioned, we are not new to litigation, and transfer pricing being a subjective law, litigation is inevitable. But if you see how the law is panned out or how the law is written all over the world and documentation, the first part of the documentation clearly states the facts. And the backbone of any TP documentation is your functional asset and risk analysis. In short, what we call as the FAR analysis. You know, when I was reading the order, there was no discussion on the FAR analysis. And I believe this is where somewhere the case got lost in between, where the proper facts were not put on table, where the discussion around the regulations and how to tie it back to the regulations, something that I saw was missing. You know, in India, we see about 4 or 5 judgments coming every day, and there is a set pattern to those judgments, where first they have the facts of the case, then they have the FAR analysis, then we have the entity characterization, and then the economic analysis. I saw the first 3 parts really missing in the order here on the function, assets, risk, the background, and the characterization. It was stage jumping to the economic analysis, where I think a lot of things got missed by I would say more by the appellant, because it's the duty of the appellant to put facts on table, and especially in front of a last fact-finding authority. So in India, a tribunal is a last fact-finding authority. So it's the duty of the taxpayer to put all facts on table and ensure the judgment actually captures the right facts. After that stage, when it goes to courts, it is only a question of law which is taken into consideration.
Thank you, Nitin. Thank you, Nitin, for that. Dr. Titi, what's your own opinion on the judgments? And what advice would you give the taxpayer? Dr. Titi, you have to unmute your mic for us to hear you.
Thank you, Amaka. I think from my own point of view, having looked at the case, it looks like a matter of not putting the best foot forward. From the way I see it, where you have a good case and you are unable to defend the robustness of your TP documentation, then these things like this will happen. And it's also from the point of view that the FIRS, because of the technicality of TP, the FIRS is actually the expert on the government side. And so there's every tendency that the appeal commissioners are going to listen to them, where the taxpayer is unable to convincingly defend his own position. So for instance, where you're sure that there's an external COP and you've used COP, I don't think there's anything wrong in you doing that, because you can prove, according to the OECD guidelines, that once you have other methods, you can actually use the COP, which you cannot easily compare. So on the overall, I think the company, what the taxpayer should have done is to defend the robustness of their TP documentation and then defend it to the end, rather than challenging the legality or the legal aspect. Because of the economics involved, it should be defended from that angle, from the OECD guideline point of view, from the UNTP manual point of view. And it's that the technicality has to come out in the judgment. Thank you.
Thank you, Dr. Titi. I completely agree with you concerning them defending their documentation. Dr. Josh, so far throughout this webinar, we've been talking about documentation. In your view, what's the importance of proper documentation and having supporting documents in place when you're undertaking an audit?
Yeah, thank you, Amaka. As I stated earlier, we cannot overemphasize the importance of TP documentation because, in fact, that is your opportunity to demonstrate to the tax authorities that your related party transactions were conducted in a manner consistent with the arm's length principle. That's the only opportunity, all right? And if we understand that that is the only time that I can fully and comprehensively tell a story about all the facts that pertain to my related party transactions, and therefore can then lead me to a technical position that I've clearly, demonstrated that I've conducted my related party transactions in a fair and reasonable manner, consistent with the arm's length standard, then we have to, take that particular documentation seriously. So the robustness of it cannot be overemphasized. Now, the problem I see here is that most taxpayers treat it as, a necessary evil, a check the box. And because they look at it that way, they commoditize it. So it's more like, which company can, actually prepare documentation at the least cost without considering, quality of that particular TP documentation. What I keep telling taxpayers is this: anybody can put together a TP documentation. Even yourself, if you don't have any clue about transfer pricing, you can look at a template and put together a TP documentation. However, the only time that you appreciate the robustness of a TP documentation is when you go through an audit. So as long as you've not been selected for a TP audit, you have a TP documentation and you've satisfied that compliance requirement. So you don't get administrative penalties for not submitting on time. But when you go through a TP audit and FIRS starts collecting their own facts, where they come to your office and interview people to gather their own set of facts and come up with their own conclusions, that's when you realize the importance of the robustness of TP documentation. And the assessments can be very, very significant. So you can overemphasize its importance. And I believe that taxpayers should make it a responsibility that they are proactively preparing a very robust TP documentation that is defensible through an audit. And if you should get to litigation negotiation, you can actually use it to your advantage.
All right, thank you, Josh, for that. Nitin and Kevin, from your experience, when you're undergoing a TP audit, what are some of the critical areas a taxpayer should bear in mind? Perhaps, Kevin, you can go first. You need to unmute your mic, Kevin.
Sorry. Yeah, so I would just like to add to what Josh was saying and re-emphasize how important it is to have robust TP reports. What does that mean? Josh was saying earlier that this is a first line of defense. So if we look at the case, just using this as an example, the court said that, if you boil it all down, right, the court is saying that the taxpayer didn't successfully defend its use of a particular method in the first year of the audit, 2013. In this case, the court said that the taxpayer didn't successfully defend why it was using this CUP method, or comparable uncontrolled price method, which is basically just setting the related party price to be something that's consistent with prices that the company charges or pays to unrelated third parties. Now, this is a good example because it's, as Josh is kind of saying, it's not enough simply to state that you believe it's reasonable to apply a certain method. You have to prove why. And as Josh was saying, a lot of folks don't maybe appreciate the importance of robust TP documentation. It's almost like, hiring a doctor or a lawyer. You have to really look at this as a pre-litigation exercise. And in litigation, okay, it's all about the preponderance of evidence. It's not simply enough to state something as so. You have to overwhelm the other side with so much evidence that any contrary, counter argument would not have much strength. So we talk a lot about, transfer pricing being a subjective area. It is, but subjective doesn't mean arbitrary. It still means fact-based, okay? So when you're going through an audit, Josh also talked about, and I think Nitin also talked about, the process of transfer pricing. Josh had a slide earlier where he was talking about health checks. Okay, the audit process is all about demonstrating transparency and respect for the audit process itself, right? And so a good report will lay out all of the facts, and in that way make the auditor's job easier because they can see how the facts are organized and how that's tied to the treatment or the policy. And the more you do that, the more I think it establishes goodwill, which you always want to have in any kind of dispute. So just to wrap up, I think in an audit, what you want to do is you want to respond quickly and fully to all of their requests for data and information. You want to make the other side's job easier. You want to do it in a respectful manner. And you have to realize, this doesn't necessarily have to be a conflict. Reasonable people can disagree, but you're trying to demonstrate to each other that there's one string of facts and that maybe there's just one conclusion that that string of facts leads to. Nitin, what about you?
Thanks, Kevin. I couldn't agree more. You put it in such simple and such beautiful words that I'm now having loss of words in explaining that. But yes, I agree. In transfer pricing, what happens? It starts with the documentation and it ends with the documentation. And when it comes to litigation, especially for transfer pricing, the first document that is picked up by anybody is a documentation. And the last comment that you have in any kind of litigation is on your documentation itself. So that is the beauty of it. It carries the length and breadth of whatever you're doing. And if you look at, the documents that are being prepared or, which are submitted at the time of audit, you submit your intercompany agreement, you submit your documentation, and you submit your backup documentation. An intercompany agreement is made for a longer period of time. Backup is submitted based on the request on what the authorities want and they want to review in detail. But TP documentation is the only document which is prepared on a year-on-year basis, and it carries everything on a real-time basis. So whatever you need to explain, you need to put across, it has to be there in the documentation. On the real-time basis, you captured, okay, this happened during the year. Especially, a typical example of COVID. I believe the documentation will have to carry the impact of COVID. Even if I don't have it and tomorrow I try and explain it, I think we'll be at loss of a lot of data where we would not know how to put it across. So, your documentation has to be as robust as it can. And when it comes to transfer pricing, like Kevin mentioned, it has to carry a uniformity. My functions will lead to risk. Risk will lead to the assets being utilized. They will lead to my characterization. And on top of that, I will have my remuneration being fixed. A typical example in this case is the case of a distributor for PPNL. I have read through the order and the supporting, the material that is there, the articles being written. But nowhere I read that what is the characterization of the distributor? Is it a limited risk distributor or is it a risk-bearing distributor? So somewhere I believe, the documentation is the most important documentation internally for the company, how you present it to stakeholders inside and outside to the tax authorities and how you present it. It's the window of your functions.
If I could just add to that quickly, I totally agree with what Nitin is saying. And in addition, sometimes it's not always possible to capture everything in the report, transfer pricing report. So again, to Josh's earlier point about health checks, internal memos to the file can be very helpful because transfer pricing documentation isn't only about documenting what matters. It's also about documenting what doesn't matter. So if there are news events or things that have happened to the company or market conditions or something that have happened throughout the year, a tax authority during the audit process is going to discover that. And then their question is going to be, to what extent does that impact the result? Well, it would be good in the spirit of pre-litigation to have an analysis of those. First of all, a disclosure of those facts. And then secondly, an analysis of those facts to maybe conclude, therefore, that those facts do not materially change the policy of the company. So, in addition, you may not always be able to have everything bundled into the report itself, and that can be supplemented by internal memos to the file.
Thank you very much, Kevin and Nitin, for that. Dr. Titi, I have a question here. Do industry and business peculiarities affect how taxpayers conduct transactions with their related parties?
Thank you, Amaka. My answer to that is yes, because industry dynamics are not the same. Business models, they also vary. So it is important that every taxpayer should be able to analyze his industry in relation to his business. It's also important that every taxpayer is able to analyze his business in relation to his strategy. And whatever comes from the transfer pricing documentation or whatever comes from the supporting documents is being driven by the business strategy. So you can decide to be a cost leader, you can decide to differentiate your business, but all this would affect the way your group runs. Some group may decide to be a one-stop shop. Everything from all the value chain is within the group, and that would affect the way the documentation is made. So it's always good for taxpayers to have this understanding. The documentation they have should also support this so that if there's case for any issue with the tax authorities, end to end, they can prove that this works in line with our business strategy, is not different from what will happen with any other person in the industry, but our own business strategy is unique to us and defend it to the letter. That is very important.
Dr. Josh, follow on to Dr. Titi's comment. How else can taxpayers stress this fact that industry and business peculiarities affect their related party transaction when they're trying to defend their control transaction?
Yeah, I think this is very critical. It's part of the fact-finding sessions of a TP documentation. As Kevin and Nathan have already stressed, if you look at the typical TP documentation, I think 70% of that TP report is all about fact-finding. You talk about the group and company analysis. What are the strategies that they implement to differentiate themselves in that industry? Look at the industry peculiarities and how it impacts their business and therefore the pricing and therefore the remunerations that participants are earning. And you then focus on the transaction itself. What are the functions being performed by those entities involved in the transactions? What risk are they bearing and what assets are they assuming or own? So all these in analysis form about 70% or 80% of the documentation. And in industry analysis and the company peculiarities are very important. So for example, going back to this case, I think it would have been instructive, for PPNL to talk about the group strategy. Why was it the case that FY 2013, the offshore entity was selling to both a related party and independent parties in the same jurisdiction? What was the rationale behind it? And what was the basis or reason for them changing that strategy come FY 2014 and stop selling to third parties and continue selling to the related party? If you tell that story, all right, and it makes so much sense, an independent panelist, a lay person who doesn't know TP, will understand the basis, the commercial rationale behind it, and would have understood why there was no internal data to be applied for FY 2014. Hence your change of methodology from a CAP method to a different methodology. Because one of the biggest arguments that FRS kept putting out there was that the reason why they changed the methodology come FY 2014 was, the taxpayer recognizing and accepting that, it wasn't even applicable for 2013. For me, that I believe was a very erroneous argument. But they could make that argument because you didn't tell your story very well for them to really understand the commercial basis for changing in strategy, and therefore internal data not being existent for FY 2014, and which forms a strong basis for change of methodology. So you cannot overemphasize the importance of telling your own story. I believe that if PPNL had told this very simple story, that would have stuck in the minds of those panelists and would have easily understood why that data wasn't in existence come 2014, because it made sense. And if that data wasn't available, the regulations as well as the OECD guidelines and UNTP manual says that you can only change a methodology if either the functional profile might have changed, some of the facts might have changed, or the data that are relevant might have changed. And this case was a case whereby the data wasn't available, so it gave them a basis to change the methodology. So some of these things would have played very well if they had done a good job in terms of the industry and group strategy, and maybe the results would have been different in this particular case.
Yeah, maybe just if I could add to that just quickly. In addition, talk about a lost opportunity. So the taxpayers' main argument was that it couldn't apply the CUP method for 2014 because there wasn't any data. They also could have argued, because the FIRS's main argument was that a gross margin was more appropriate. Okay, so to TT's point, it really depends on how a business operates. In what kind of cases, you have to ask yourself, is it appropriate to compensate a related party reseller on the basis of a gross margin versus an operating margin? And if you think about it, you can organize it into two extreme cases. If we're talking about product sales, products that are so unique and valuable to end customers that they practically sell themselves, therefore don't require an intensive sales effort. And in that case, a gross margin is appropriate because it's incumbent on the reseller to maintain an efficient cost structure, because the gross margin by definition doesn't guarantee an operating margin. On the other hand, products that do require an extreme amount of sales effort because they don't sell themselves should be compensated on the basis of an operating margin, because it does reward the below the line efforts. So you wouldn't understand this if and clearly the FIR and the court did not, because it wasn't presented to them. So to your point and to TT's point, this all has to do with, transfer pricing, just the framework oversimplifies how businesses operate. In transfer pricing, if there's residual profit, there's this assumption that there must be unique and valuable IP. But in commodity markets, there is no IP, right? It's a supply and demand issue. So, this is all getting back to your point, Josh, about having robust documentation. These are facts that need to be developed. And in this case, I feel like in addition to it not being feasible to apply the CUP in the other year, there was maybe a missed opportunity in terms of dismissing the feasibility of applying a gross margin method as the FIRS did.
Okay.
Thank you, Kevin and Josh. We have a question from a participant. He wanted to know, does the OECD allow for the use of the gross profit margin method as a PLI for TNM? Anyone, Kevin?
Sure. The wording in both the OECD guidelines and the UN manual says that it's not usually the case that it would be appropriate, but it doesn't specifically disallow it either. in the US, the analog for the TNMM is the CPM, comparable profits method, and it is quite often used. But the OECD guidelines and the UN both also contemplate other types of PLIs that make use of a gross margin type of method, like the Berry ratio. Okay, so there's an acknowledgement, but it's I would say it's not often used, but it doesn't explicitly disallow it.
Josh, do you have anything to add?
Yeah, just to add to what Kevin said, and I fully agree with him, so I don't think that the whole argument, had to be boiled down to whether or not it was appropriate to use gross margin for the TNMM or a net margin PLI for the TNMM. For me, what was very instructive was the fact that the taxpayer has a burden of proof, all right? The taxpayer had a good faith in actually performing this analysis. Both have agreed that the TNMM was the most appropriate methodology. The taxpayer has gone ahead to apply the TNMM based on the guidance that was available to them, which is the TP regulations, UNTP manual, and the OECD guidelines. Now, from a best practice point of view, if you look at UNTP manual, which was specifically developed for developing countries' tax administrators, so it was actually simplified for them to understand. And because of that simplification, there's an emphasis of the use of net margin PLIs. So if as a taxpayer I'd follow this guidance, and really it points to the fact that the most appropriate PLI for the application of TNMM was a net margin PLI, it would take FRS a very extreme basis to then overturn the use of what is the best practice. Now, as Kevin said, if you look at these cases, they were all making very stretched, extraneous, assertions. FRS claimed that, using the gross margin for the TNMM was actually the best practice and commonly used. That's false. That's totally false, right? It can be used, but it's not the norm. You understand me? So that was an extreme statement that needed to be corrected. You understand me? And secondly, I have the burden of proof, and I deemed it to be the appropriate PLI. So you need to have a very strong basis to overturn what is actually the best practice and the norm based on the guidance. So I don't think that the argument is whether you can ever use gross margin for TNMM, but from best practice and the guidance, it has to be a net margin. And given that the taxpayer had used that in good faith, I don't see the reason why it was that easy for FRS to then, jettison, the net margin PLI and go for a gross margin. But I also agree with Kevin that the taxpayer needed to have a clear basis why they were going with a net margin. And apart from the strategy from the first point of view, there's also the technical argument, all right? And just, I know I'm going a bit far, but when you are using external data, all right, and the UNTP manual recognizes it, external data means that you are using a database, that we subscribe to. Typically, because African companies are not publicly listed, you hardly find African comparables in that database. So you end up finding comparable companies from different jurisdictions, typically Eastern European countries, that are deemed to be comparable to African countries, which are also emerging countries. Typically, the accounting standards might be different. So the treatment of cost items into your cost of sale bucket or operating expenses bucket might be different. And that's a clear reason why many a times when we are using external data, we end up using the TNMM, because you don't have to really bother about whether cost item was consistently put in the cost of sale bucket or the operating expense bucket, all right? And that is the reason why we tend to use TNMM. In this particular case, it was applicable. So those are some of the arguments that the taxpayer could have used to defend the reason why the net margin was actually more appropriate, in line with their, their strategy, as well as the accounting inconsistency argument. But they didn't do a good job with that.
George, just to add here, for a minute, being a case of a distributor and having, a discussion around the, the gross margin, the case did not even have an iota of discussion around the resale price method, where a taxpayer could have argued that, resale price method is not applicable in this case due to an XYZ reason. To be honest, I did not read any of those arguments, or any of the discussion around resale price method. So, I totally agree. It's about a lost opportunity. And the second important observation that I had is, the case is where at the resale, at the gross level, the company is not at arm's length. but at the net level, the company says it is at arm's length. So that means the company is undertaking certain functions, or rather not undertaking certain functions, and the comparables are undertaking certain functions. That is why the below the line expenses are really affecting the overall profitability. Even in those situations, all regulations, especially I know I can talk about the Indian regulations, they allow that in case there are any functions which materially affect the transfer price or the arm's length price, you are free to undertake some adjustments. I did not even see any discussion around the adjustments that, you know, either the taxpayer proposed or, you know, the FIRS proposed, IFRS proposed that, you know, let's have those adjustments and see where do we reach. You know, the case was made plain vanilla, but it was not such a plain vanilla between the net level and the gross level analysis.
Right, thank you very much, Nitin and Josh. Dr. Sisi, I have a question from a participant. It says, do you think that the case failed due to wrong arguments and lack of proper documentation, or the ignorance of the TAT panel on transfer pricing rules?
Thank you, Amaka. Most times I'm always careful to use the word ignorance because everybody has knowledge in their own way. What I will say is because of the technicality of transfer pricing, even not all experts understand the economics behind how it operates. So there are two sides of it. The first side is the taxpayer not being able to convincingly break down their operation to ensure that the TAT understands the basics and move from the unknown to unknown so that everybody carries along. That is possible. That's likely what may have happened. The second thing is that the TAT commissioners are not experts in transfer pricing because of what it takes. Even normal tax cases, we see a lot of things that come up on the normal tax case that are simple companies income tax law. So this is expected because we are not expected to be experts. But if the taxpayer have tried to drive their points from the simple to the unknown and make sure that everybody is carried along and defend why they are doing a particular pricing against another form of pricing, defend why they are using net margin and not gross margin, defend why they're using COP and not TNMM, then it would have made it easier for the TAT to either go back and do some assignments, to do some transfer pricing training, to understand all those slogans, to be able to come and give the judgment. That is what I think is happening.
All right, thank you, Dr. Sisi. Nitin, we have a question here. Could there be scenarios where an entity is allowed to charge its related party a lower price compared to similar uncontrolled transactions?
The answer to that is a yes. You know, all regulations do allow for an interquartile range, and you know, you're free to decide the price on the interquartile range. The fact that a range is provided because all companies undertake functions which can be different in the intensity. So basis the intensity, you can pick up the transfer price, and you know, the price can be different, and the price may not always have to be at the median.
Okay, thank you, Nitin. Dr. Josh, I'm getting a lot of questions about dispute resolution. So what are the various TP dispute resolution options available to taxpayers in Nigeria, and how effective are they?
All right, I would say, in my view, there are three common ways you can resolve a dispute in Nigeria when it comes to transfer pricing. The first is to settle, you know, and usually settlement, what we see is that they usually negotiate for a payment term that is favorable in terms of managing cash flow. So you have some taxpayers who will say, okay, I want to settle. I don't want to actually push against what I believe is not right, but I want to settle, and they agree to a payment term for cash flow management. The second, obviously, and the most common, is to negotiate, where they go out there and negotiate because FRS has an incentive to close cases early. They need the cash, all right? So they have an incentive not to take it to litigation because of, you know, time value of money, right? So they have an incentive to negotiate, and then you come to some particular agreement, and usually what you agree to will be lower than, you know, the amount that FRS would have assessed, you know, in the form of additional tax liabilities during the audit. So that is a very common, dispute resolution option that we see here in Nigeria. What we stress is that even though your strategy is to negotiate because you don't want to litigate, because which can be costly and takes and time consuming, you want to go into that negotiation from a position of strength. And how do you go into it from a position of strength? It's only when FRS believes that there's a high probability that if they should go to court, all right, they could lose. All right, in that case, they have a bigger incentive to negotiate and settle without going to court. So I don't think it's a very good strategy for taxpayers when they start from the onset that our only option is going to be negotiate without the potential consideration of litigation as a last resort. Because if you go with that mentality, you don't go from a position of strength. Because if you go with the mentality that, look, I know that I did the right thing, I wouldn't like to go through the route of litigation because it's costly to both of us and it's going to be very painful. But I want us to negotiate. But I know that I did the right thing. And these are the reasons why I believe if we should go to court, I have a higher probability of winning. That in itself shows that you are coming from a position of strength, and hopefully the outcome might be beneficial to you, although it will end up being win-win for both parties. But if you go in from a position of weakness, where you are so desperate to negotiate and FRS wants to maximize their tax revenue, maybe whatever you settle on might not be something that you call a win, and you come out with a lose-win position, which will leave a very sour taste in your mouth afterwards, all right? Now, the dangerous part about such is that usually the transfer pricing arrangement might not change. So come next year or sometime in the future, FRS comes back with the same position and takes away some money from you. So basically, you need to be providing for such settlements going forward. And I don't think that is good business. All right. The last option, obviously, is litigation. Unfortunately, in Nigeria, I recognize that most taxpayers are shy from the whole idea of litigation. One, because of mistrust of the court system, especially TAT, because they believe that they might not get a fair hearing, which has been articulated by some. Two, they might think that TP is too technical. And even if the panel wanted to be fair, they might not even understand the issues to come up with a fair, outcome. And three is the whole idea. Some just don't want to be in the news for litigating, right? They think that it can have an adverse impact on their public image and other reasons. So typically, you do have these three options. Now, there could have been a fourth, arbitration, which we thought that the decision review panel was going to be. So the decision review panel was part of our TP regulations, and it's supposed to be a separate body that will look into the outcome of that audit process. Unfortunately, that body is not independent of the International Tax Department that is involved in the audit case itself. It's actually chaired by the head of the International Tax Department, which means that he is basically reviewing his own work. So you cannot expect the outcome to be any different from the audit process. So it's not actually an arbitration body because it's not independent. It's just a process of validating what they've done. I think they can do a better job of replicating what we see in other jurisdictions. The last one I will talk about, which is not a dispute resolution option, but can help mitigate our number of disputed cases, will be the advanced pricing arrangements, APAs. Basically, we will see that in US, they do have that. Now, India resorted to APAs when they realized that we're having too many litigation cases. Government recognized that we need an avenue where the taxpayer and the tax administrators can proactively come together and discuss and agree on a pricing arrangement even before we go through an audit process and end up with these disputes. We have it in our regulation, but it's not been implemented. And I believe that it's about time we push for the FRS to implement APAs because litigation is actually very costly for both parties.
Sorry, Amaka, can I just say that following what Josh has said, like he said, we shy away from going to court. It's not only in TP matters, other matters also. And I think it's coming from the mentality that we have around this thing. But it's always good to test the waters for some of these things. It's when you test it that you know you have a good case or you cannot defend yourself. So that's what we've been experiencing in different matters. Apart from the technical skill, the technical understanding, because even if you go to court and the people that are going to sit to judge the case don't even understand what you're talking about, then what are you going to come out with? So those are all the things that makes most taxpayers to want to sit back and think of other options rather than just going for litigation straight away. But be as it may, I think it is worth testing some of those options, because settlement means every year you have to continue to do that settlement. But once you try it, get it right. If you're sure, I always say that if you're sure of your facts, challenge it. Anybody that says no, they don't agree, then the onus of proof will be on them and no more on you, because you are proving your own. So it's good to test some of these things, but the cost, the time it takes, the effort, the stress, I think these are why people always shy away from the litigation, but it ends up giving you a good judicial precedence in any matter that you take to the court.
Thank you, Dr. Tsitsi and Josh. We have a couple of questions concerning TP documentation, the difference between TP documentation and TP returns. We also have questions about if you have a loan, what type of documentation do you need if you have reimbursables? Dr. Josh, can you just briefly explain the difference between the two sets of documentation?
All right. First and foremost, just so that we are in line with the TP regulations. So the Nigeria TP regulations has two major requirements that taxpayers are obligated to meet if they have TP issues. Your first obligation is to file TP returns, all right? And when it comes to filing of TP returns, there's been an ambiguity as to who has that responsibility. When the TP regulations came into force, in 2012, 2013, there was a general acceptance that once I have a related party transaction, then I have that obligation. However, there were follow-up documents that kind of suggested that even when you don't have a related party transaction, you need to file nil returns to tell us that you don't have a related party transaction. That clarity has not been made, all right? So, but one thing we know for sure, once you have a related party transaction, you need to file TP returns, which comprises of two forms. The TP declaration form, which basically declares the relationship we have with your related parties, the group structure, the board of directors, because that information helps them establish whether you have related parties. The TP disclosure is where you disclose, the value or volume of related party transactions, the methodology you use to actually determine that those transactions were conducted at arm's length. So you just state the methodology, the jurisdiction that those related parties are, because it gives them an idea whether those related parties are in a tax-friendly jurisdiction, which would then might give you an incentive to shift profit to those jurisdictions. So TP disclosure focuses on the transaction itself. So the combination of the declaration form, which focuses on the group structure, versus the disclosure, which focuses on the transactions, can enable FIRs establish that you do have a related party transaction, and therefore make determination whether to audit you or not. So that is the TP returns filing. All right, so it's just a completion of forms, and then you submit. So these are disclosures. That is totally different from the TP documentation. So the TP documentation and the returns, filing of returns usually goes with your filing of income tax returns. So it's pretty similar. Whenever you're filing income tax returns, you need to be filing your TP returns. Now, TP documentation, it's totally different. It's your first line of defense. That's where you prepare a document demonstrating that those related party transactions were conducted at arm's length. Now, there's clear guidance from the TP regulations as well as OECD guidelines as to the things that you need to cover to make that case, all right? The FAT guidance section and the economic analysis sections in order to make that case. Now, according to our regulations, it's supposed to be prepared within a particular time frame, all right? So if for FY 2013, if I'm a December 31st year end, that TP documentation should have been prepared on or before June 30th of 2014 when I'm filing my TP returns. However, there's no penalty for not meeting that particular deadline. So really, people do not actually adhere to it the way they are supposed to. But if FIRS were to select you for an audit and makes a request for that TP documentation, they give you 21 days to submit that TP documentation. And if you're not able to meet that 21 days, that's when the penalty kicks in. So the penalty kicks in if you're not able to avail your TP documentation on time when it's requested for. Now, anybody who's prepared a TP documentation knows that it takes a while to prepare it, right? And usually you're going to be audited for multiple years, FY 2013, 14, 15, 16. So if you've not prepared any TP documentation and the FIRS were to make a request and tell you to submit 4 TP documentation reports within 21 days, there's no way you can meet that. That's where the penalty kicks in, all right? And for missing each one, you get at least 10 million. So you can see the multiplier effect. So there's a clear distinction between TP returns and TP documentation. They satisfy different objectives, but they are all important. The first one are disclosures. The second one is a report or documentation. That clearly demonstrates that you've been able to meet the arm's length principle.
Thank you, Josh. Quickly, can you mention where the TP policy plays in terms of the documentation?
All right. So there's been a lot of confusion in our part of this world when we use the word TP policy and TP documentation. All right. Typically, TP policy in different jurisdictions might be called TP planning report. The whole idea of TP policy is preparing a document that guides the group in terms of how they price their related parties transactions in order to meet the arm's length principle. Typically, it's an internal document. The audience or the report is not targeted at being submitted to the revenue authorities per se, and it's usually prospective in nature. All right, so I'm going to enter into some related party transactions, and I'm saying, can you give me some advice based on some benchmarking analysis as to how to price it so that I meet the arm's length principle? So it's a planning document, or it's a policy. It's internal. All right. Now, TP documentation is a compliance documentation that is in compliance with a regulatory requirement. There's nowhere in our TP regulations that mentions TP policy. All right. It mentions TP documentation, and there's a requirement for it. However, the confusion came up, in the early years of the transfer pricing regime in Nigeria. When FIRS started, all right, nobody had put together a TP documentation because they gave us a 1-year moratorium period, to actually prepare this. However, they wanted to have a sense of what taxpayers were doing. So they requested for TP policies from taxpayers during that period. Now, taxpayers were confused. What is a TP policy versus what is a TP documentation? So at that moment, some people just gave them agreements as their TP policy, which is fine. It tells us our intention as to how we are going to price a related party transaction. Some taxpayers prepared a TP report, but there was no financial analysis to test the financial results of the entity. But since then, all right, FIS has never asked for TP policies. They've kind of focused on TP documentation. So there's been a confusion as to what is the difference between TP policy and what is the difference and TP documentation. But today, the focus is on TP documentation. TP policy is typically an internal document and usually prospective in nature. TP documentation is retrospective. What did you do for a particular financial year in terms of related party transactions? And how did you demonstrate that you met the arm's length principle?
Thank you.
So I just want to add that Josh, thank you for putting that forward. Mostly, it's better for taxpayers to understand that policy is important, because that is what will guide what you're going to put in your documentation. Where you don't have a TP policy, everybody does things anyhow. But the policy is like the brain box that says, for anything you're doing in this company, within this group, this is how we want to do it. You have a range of your pricing. You have the type of transaction we do that guys. So when you now come to the documentation, you are now breaking the policy into details of what really happened within the framework of the policy. So it's always good to have the policy. That is the mind of the management. That's the mind of the board. This is what we want. It's like the boardroom instrument to guide the company on TP matters. Now, the documentation is more detailed. It goes into the smallest document you need to have. It goes into the smallest transaction that takes place within the group. And so it's always necessary to have that policy guidelines that will tailor everyone towards what the company is looking out for, what the group should be doing in terms of which transactions and how it should be priced. So you can work within that range. So when you are submitting your documentation, you have something you're speaking to. You are not acting in the cloud, not knowing where you're going, but you have a direction which is you're following, and you have where you're heading to, which your documentation will give you. So that's why, like we said, it starts from documentation, it ends with documentation, and that's how TP works.
Thank you for that, Dr. Titi. Nathan, I have a question here from a participant. The participant states that where a related party inflated the price of the supply when they're selling to a third party, so the uncontrolled price is inflated, can the tax authority then argue that there should be an adjustment? So if the uncontrolled price seems inflated and the related part, the transfer price, is also, at the same price as the uncontrolled price. Can the tax authority then come and argue that there should be an adjustment?
Yes, if they're auditing, they have a full right to check on the transfer price and on the arm's length price. And it is very interesting on a third party prices being inflated to adjust the related party price. But if push comes to shove, then these cannot be a very uncommon transactions here. But yes, tax authorities do have the full right to review that, to audit that, and to then correct the arm's length price to determine the right transfer price.
Right. Thank you, Nixon.
Sorry, Amaka, I just want to say that that is a bit daisy because is the adjustment going to be within the group, and then what happens to the third party price? That's a bit.
In fact, they can't change the third party price.
Cause for worry.
Yeah, let me. I hope Kevin can make some comment here, because for me it goes to the fundamental economic theory and transfer pricing.
Yeah.
Let me use my layman economic theory, because he's my boss when it comes to economics. So if you look at the underpinning argument, right? Market prices are supposed to be determined by market forces.
Yes.
All right, demand and supply. So assuming that it was extremely comparable to that of the related party, and you are using prices as your basis of comparison, as opposed to a different methodology, for example, you're using COP, and it's been clearly established that, look, I did sell to the market. It's comparable in terms of the product. It's comparable in terms of the contractual terms. It's comparable in terms of the market in which I'm selling. And I've met that high comparability standards. I find it difficult how FRS can establish that market price is inflated if I've met all those comparability standards, and therefore come back and say I should make an adjustment, because that's the whole underpinning of the arm's length principle, especially if you focus on the pricing element itself. So for me, I find it very difficult. So I'm wondering, Kevin, would there be some instances, exceptions, where tax authorities can actually argue that I've met all the comparability standards, but the market price is inflated, so I should make an adjustment to the controlled price, which is the controlled price.
I totally agree with you, Josh. If the profile was as you said, then yeah, that would be reflective of the market condition. But interestingly, this has come up in U.S. cases where I think the spirit of the question was if a third-party price was manipulated by the taxpayer to otherwise represent what might look like a third, but it wasn't really a third. That has come up, and so that's more of that's a false comparable. So in that case, the IRS would throw out the comparable and basically deem the third party as basically a related party, because as you know, the test in the US is it's not an ownership test, it's just whether the parties are acting in concert or with a common purpose. So in that case, they would throw out the comparable.
Yeah.
All right, thank you for that. I have an interesting question about domestic transactions. As we know, the Nigerian transfer pricing regulation includes domestic transaction. So perhaps Josh or Dr. Titi or any of the panelists can answer. Do you think the FIRS would have been indifferent about the adjustment had the transaction been done between two domestic entities, knowing they are both covered by the same tax jurisdiction, and the fact that overall one adjustment would lead to a corresponding adjustment?
Amaka, let me start before Josh and Kevin others respond. This has always been my issue when it comes to the Nigerian TP regulation and the peculiarity, but I know it's not only in Nigeria that we have this. Other jurisdictions also have domestic issues. The critical thing is there a relationship between the companies? Are they covered under the regulation? So whether it's domestic or international, as long as it falls between the connected parties description of the transfer pricing regulation, it has to also be captured. Now, the issue of adjustment, mind you, the adjustment is on two different companies. There will be some leakage if there's going to be any adjustment. Transaction taxes might be affected also. So where there's an adjustment on one company and the adjustment corresponds is not on the other company, there's a leakage. Now, where there are transaction taxes coming from that adjustment is going to be a tax, a cost to the group. So these are things that has to be considered, whether it's domestic or international. So as long as there's a relationship and they fall into the connected taxable persons, then they are not exempted. So any adjustment made would have effect. The only thing I always say is that I have not seen a situation, maybe that will happen, where you have an adjustment to a Nigerian company and the other company is giving, for instance, you adjust my revenue, increase it, you have to go and reduce the cost at the other side. But those are the things that I feel will start coming in when the domestic side is taken up.
All right. Just to add to what Dr. Titi has said, and I fully agree with all the comments she's made. Clearly, what we need to understand is that depending on the nature of a transaction, all right, it might have its own sources of risk, okay, and therefore lead to its own potential TP audit trigger. So clearly, if you look at this particular case, one of the reasons why it triggered an audit and and detailed audit was the volume of the transaction. Another was the fact that it was cross-border. What we don't know is the location or jurisdiction of the offshore entity. Let's assume that it's located in a jurisdiction that has a lower corporate tax rate. Then clearly for FRS, there's an incentive to shift profit to that entity so that the whole group as a whole benefits from a lower effective tax rate. So there are a number of factors that FRS will look into to think that there might be an incentive to misprice that particular product. Now, should both entities be domestic, right? Clearly, this whole potential and the risk of shifting profit outside of US and outside of Nigeria will not be part of it, right? But that volume will still be there. There'll be huge volume of transaction. Now, the next question would be whether both entities who are domiciled in Nigeria are facing the same corporate tax rate. If one is loss-making and therefore is paying different level of taxes, there's an incentive to shift profit. So FIS will give you the same level of attention. If one is enjoying tax incentive in the form of pioneer status and the other one is not, FIS has an incentive to look into it because there's an incentive to shift profit. All right. If one is in a free zone area, there's that incentive. So irrespective of the fact that it might be within the geographical confines of Nigeria, doesn't mean that there might not be an incentive to shift profit. Now, where both entities face the same corporate tax rate, all right, then there might not be an incentive, okay, but it doesn't mean that FIS still doesn't go ahead to audit them. The problem, and I agree with Titi, is the fact that FIS doesn't have clear guidelines as to the process of corresponding adjustment for domestic transactions. We covered that for cross-border in terms of our double tax treaty, but we don't cover that for domestic transactions, which is under our own purview. You understand me? So for me, that's a problem. So what will happen is that we both face the same corporate tax rate. You make an adjustment because you've established that the price was inflated, but you don't make a corresponding adjustment because you've not started auditing the other company. So there's a timing issue, all right? And that moment, as Titi said, there are implications for transaction taxes, and I become worse off. So clearly there should be a process of corresponding adjustment that has to be done immediately so that it doesn't really lead to this. For me, I don't think that if there's no incentive to shift profit, they should even spend limited resources auditing such companies, because clearly the government is not going to be shortchanged in that case, because if this guy is overpaying, somebody's underpaying, you understand me, one way or the other, and it balances out. So I think that should be the best practice for FIS, given that they have limited resources, and there are others they can focus their resources on, as opposed to domestic companies facing the same corporate tax rate and really do not have an incentive to shift profit from one company to the other.
Okay, thank you very much, Dr. Josh and Dr. Titi. Unfortunately, we're running out of time. Just before we take final thoughts, I have a question for Dr. Titi. There's a question about selecting TP advisors. Dr. Josh talked about the importance of having good representation during an audit. Perhaps you can share what are some of the things you may look out for when selecting TP advisors.
Thank you, Amaka. Short of saying you are trying to set me up on this. I think when it comes to TP advisor, the first thing I look out for is who is that advisor that would understand my problem? And who is that advisor that would be able to make the problem as simple as possible to me and solve it for me? The third thing is to look at responsiveness of an advisor, because it's of no use having an advisor who doesn't respond and tells me to wait, and then the FRS is at my door and I'm running up and down. So the fourth thing is to look at the cost efficiency. You know, I've got to manage my costs, irrespective of what it takes. You know, cost is the bottom line. We have to look at that. And lastly is to look at an advisor who has very good interpersonal relationship, both on the side of the tax authorities and also in maintaining that relationship with me as the client. So it's something that I look out for, and there may be some other things, but these are things that stands out and maybe put the consultant or the advisor in the face of the company or the taxpayer.
Thank you very much, Dr. Titi. Unfortunately, we can't take any more questions. However, if your questions were not answered, we will respond to those questions via email. So can we have final thoughts, Kevin?
Sure. So just real quickly, you know, Josh started off by talking about the importance of the facts, and everybody's talked about that. Dr. Titi and Nitin, we've all talked about the importance of the facts and the narrative. I guess I would just say, just as a strong narrative cannot overcome weak facts, and anybody who's a parent of small children knows this to be true. You know, you see the empty cookie jar and you see crumbs all over the child's face. You know, the cookies have been eaten, right? So no story is going to get them out of that. So a strong narrative can't overcome weak facts. By the same token, you know, strong facts cannot be overcome by, or weak facts cannot be overcome by a strong narrative, and weak facts or strong facts cannot be overcome by, or cannot overcome a weak narrative. There's that middle part though, which is analysis. You know, facts, analysis, and narrative, they all go together. And Nitin talked about functions, asset, risk, functional analysis. What we haven't talked about is a contribution analysis. A functional analysis tells you who does what. A contribution analysis tells you what's the importance of who does what. So that's the piece, I think, and tying it to the last question to Dr. Titi about how do you choose an advisor. That's the piece that an advisor can bring to the table, is how do you stitch together the facts with an overlay of the regulations and tie that to a narrative. Okay, that's the economic analysis. Those are my final thoughts.
Thank you, Kevin. Nitin, is Nitin here?
I think he's off.
Okay, Dr. Titi. Final thoughts.
Okay, thank you. My final thoughts. I think I would say that all taxpayers have to take their contemporaneous documentation serious and get it right the first time. It's always necessary to have it right the first time. I would also want to say that cost of non-compliance with the TP regulation is expensive compared to the cost of doing it right and getting it right. Above all, whether you're looking at it from an in-house or from the tax advisor point of view, the change in the TP terrain locally, globally is very, very significant. And if you don't manage the risk, then there'll be sleepless nights. That's my own words. Thank you.
Thank you, Dr. Titi. Nitin, are you with us? Final comments, final thoughts.
Kimaka, I believe this is just a case of a lost opportunity. There was, a lack of facts and FAR analysis put in there, lack of jurisprudence and jurisprudence all over the world, which could have been used in this case to harpoon on the point of what is the best method. And there was no discussion on comparables. So I thought this is just a case of there had a lot of avenues or a lot of leeway over there for them fight back on the case, or to come back to the right transfer price, or to harpoon on a different method, or try and get their point across in a different way. So I believe a lot would have been done, and that's where I leave it from the perspective of transfer pricing.
All right, thank you, Nitin. Dr. Josh? You have to unmute your mic, Josh. Thanks.
Yes, thank you very much. My final thoughts would be the fact that I concur fully with Kevin. Transfer pricing is a journey from your filing of TP returns, even before you file TP returns, from preparing a TP planning report, a TP policy to guide the business in terms of how they price their related party transactions, to your compliance obligation of filing TP returns, through your preparation of TP documentation, which is your first line of defense, through the audit process where you are trying to convince the tax authorities that you did the right thing based on the TP documentation, through the TP dispute resolution phase, whether you are negotiating or you are litigating or even settling, you need to have all these in mind from day one, right? You don't have to wait till it happens before you react to it. So proactivity is going to be very important. And choosing a TP advisor that starts that journey with you from the very beginning through to the very end is very important. And that TP advisor should be able to help you make the right disclosures, identify the sources of risk, make sure that those sources of risk are mitigated in the TP documentation through an audit process. Make sure that they have that understanding of the business, the documentation, to have the proper narrative to convince tax authorities so that hopefully you can come to a conclusion that is win-win for both parties and avoid very costly TP dispute resolution process. However, should it come that we have a significant dispute and we should negotiate or even go to litigate, you need a TP advisor that can negotiate from a position of strength on your behalf. And if you want to litigate, you need a TP advisor who can actually tell that story, on your behalf, such that even the layman, the panels need not be TP experts. And you are never going to get TP experts as panel. That would be wishful thinking. You are not going to get it anywhere. So your ability to explain technical stuff based on facts, all right, to them, convince them so that they understand that really you've actually met that burden of proof and you've met the arm's length principle is going to be very critical. So I hope that we make the right choices and not treat TP as a check the box item, but a valuable service that needs to be taken into consideration when we are making those decisions so that we can mitigate these billions of additional tax assessments in the future.
All right, thank you, Dr. Josh. Really like to appreciate each one of you, each one of our panelists for taking out your time. I know it's still like 2 a.m. for Kevin, but thank you so much for taking our time to be part of this panel session. We're just going to conclude. I also want to appreciate the participants of this webinar. We had about 200 people joining on this webinar, so we'd really like to appreciate each one of you. Also, Anderson Tax will also be having other webinars. There will be a transfer pricing webinar in a couple of weeks talking about the impact of COVID on transfer pricing. So we'd like to invite each one of you to join us also on that webinar. Okay, so thank you so much for your time. Thank you, panelists. Thank you, participants. I trust we'll all have a great day. Thank you very much.
Thank you.
All right.
Thank you.
Thank you, Amaka.
Thank you.
Bye. Thanks.